In this video, we look at why trade futures instead of Forex. Have you switched from Forex to futures? What has been your experience? Leave your futures trading reviews and thoughts in the comments section below. Trading futures instead of Forex offers unique advantages that cater to different types of traders based on their goals, strategies, and risk tolerance. Here are some key reasons why traders may prefer futures over Forex. 1. Regulated markets in futures trading. Futures markets operate within a highly structured regulatory framework that ensures fairness, transparency, and accountability for all participants. In the United States, futures trading is primarily overseen by the Commodity Futures Trading Commission, CFTC, a government agency that enforces strict rules to protect traders from fraud, manipulation, and abusive practices. Additionally, exchanges like the Chicago Mercantile Exchange, CME, and Intercontinental Exchange, IC, have internal mechanisms to ensure compliance, such as market surveillance and adherence to standardized trading protocols. This regulation provides traders with confidence in the integrity of the market. For example, futures prices are openly displayed on centralized exchanges, reflecting true market dynamics without broker interference. This contrasts with the Forex market, which operates on a decentralized over-the-counter (OTC) basis. In Forex, brokers often set their own spreads and prices, which can lead to conflicts of interest, slippage, or even unfair trading practices such as stop hunting. Another critical aspect of futures regulation is the role of clearinghouses, which act as intermediaries for every trade. Clearinghouses guarantee the settlement of trades, eliminating counterparty risk. This means that even if one party defaults, the clearinghouse ensures the other party receives their due. In Forex, trades occur directly between participants or through brokers, leaving traders exposed to potential defaults or unethical behavior by their counterparties. 2. Centralized exchanges in futures trading. One of the defining characteristics of futures markets is their centralized nature, which provides a transparent and standardized trading environment. In a centralized exchange, all transactions are routed through a single marketplace, such as the Chicago Mercantile Exchange, CME, or the Intercontinental Exchange, IC. These exchanges serve as hubs where buyers and sellers meet to trade contracts with clearly defined terms, such as quantity, quality, and expiration dates. This centralization creates a uniform price for each contract, ensuring all participants have equal access to real-time market data. Traders can rely on accurate and transparent pricing, as the order book and trade executions are openly available for scrutiny. This structure contrasts sharply with the decentralized nature of the Forex market, where transactions occur over the counter, OTC. In the Forex market, prices can vary between brokers due to differences in liquidity, spreads, and market-making practices. This lack of standardization can make it difficult for traders to determine the true market price. Another significant advantage of centralized exchanges is the enforcement of standardized contract specifications. For example, a futures contract for crude oil traded on the CME specifies exact quantities, delivery points, and quality standards. This eliminates ambiguity and ensures that all parties in a trade have a clear understanding of the terms, reducing disputes and misunderstandings. In Forex trading, there are no such standardizations, as trades are custom agreements between parties, which may lead to complexities and discrepancies. Centralized exchanges also foster liquidity by attracting a diverse range of participants, including institutional investors, retail traders, and commercial hedgers. This broad participation ensures tighter bid-ask spreads and better execution quality for traders. In Forex, liquidity can vary widely depending on the broker, the currency pair, and the time of day, potentially leading to higher trading costs or slippage. Risk management is another critical benefit of centralized exchanges. These markets operate with the backing of clearinghouses, which act as intermediaries in every trade. Clearinghouses ensure that both buyers and sellers fulfill their obligations by requiring initial and maintenance margins, thus reducing counterparty risk. In contrast, Forex transactions often rely on trust between parties or depend on the financial stability of the broker, increasing the risk of default or fraud. 3. Leverage with clear margin requirements in futures trading. One of the key reasons traders may prefer futures over Forex is the structured and transparent approach to leverage and margin requirements in futures markets. Leverage allows traders to control a large position with a relatively small amount of capital. While both futures and Forex offer high leverage, the futures market stands out for its clarity and consistency in how margin requirements are set and managed. In futures trading, leverage is provided through initial and maintenance margin requirements, which are standardized by the exchange. The initial margin represents the minimum amount a trader must deposit to open a position, while the maintenance margin is the minimum amount of equity that must be maintained to keep the position open. These requirements are calculated as a percentage of the contract's total value and are clearly outlined for each contract type. For example, the Chicago Mercantile Exchange, CME, sets specific margins for contracts like crude oil, gold, or S&P 500 futures, ensuring all participants know exactly what is required. In contrast, Forex leverage can vary widely between brokers and jurisdictions, often reaching ratios as high as 500 to 1 in some unregulated markets. While such high leverage can amplify gains, it also significantly increases the risk of substantial losses, sometimes wiping out an account in a single volatile move. Forex brokers set their own margin requirements, which can change without notice based on market conditions or internal policies, creating potential confusion for traders. Another benefit of the futures margin system is its transparency. Traders can easily access information about margin requirements for each contract, allowing for better risk management and planning. In Forex, hidden costs related to leverage, such as rollover fees or changes in margin requirements during high volatility periods, can erode profitability and catch traders off guard. 4. Defined contracts and expiration in futures trading. One of the most significant advantages of futures trading is the standardized nature of contracts, which brings clarity, consistency, and predictability to traders. Futures contracts are legally binding agreements to buy or sell an underlying asset, such as commodities, indices, or currencies, at a predetermined price on a specific future date. Each contract is meticulously defined by the exchange on which it is traded, specifying essential details like the contract size, tick size, expiration date, and delivery terms. This standardization ensures that all traders operate under the same conditions, reducing confusion and streamlining trading. The inclusion of expiration dates is a distinctive feature of futures contracts. Each contract comes with a set lifespan, which typically aligns with market cycles or seasonal considerations for commodities like agricultural products or energy. This expiration date serves as a natural endpoint for speculation, requiring traders to close or roll over their positions by a specific time. This aspect fosters disciplined trading and minimizes the risk of indefinite exposure, which can be a concern in Forex, where trades lack expiration dates and may accumulate costs over time due to rollover fees. In Forex trading, contracts are not standardized because trades occur over the counter, OTC, between participants, with terms varying by broker. This lack of standardization can lead to ambiguity, especially for newer traders who might struggle to understand the implications of flexible lot sizes or custom leverage settings. The well-defined structure of futures contracts also simplifies risk management. Traders can easily calculate their potential exposure, profits, and losses based on the fixed parameters of each contract. This transparency allows for more precise strategy formulation and portfolio management, making futures trading particularly appealing to institutional investors and experienced retail traders. 5. Liquidity and volatility in futures trading. Liquidity and volatility are two crucial factors that traders consider when choosing a market. The futures market excels in both areas, offering advantages over Forex trading, particularly for those seeking efficiency, stability, and predictable trading opportunities. Liquidity in the futures market is high, especially for major contracts like crude oil, gold, and the S&P 500. This is due to the broad participation of institutional investors, retail traders, and commercial hedgers. The centralized nature of futures exchanges further ensures consistent access to this liquidity, enabling tight bid-ask spreads. This reduces trading costs and ensures swift order execution, even for large volumes. While Forex is also highly liquid for major currency pairs, such as euro to US dollar or US dollar to Japanese yen, liquidity can diminish significantly for exotic or less frequently traded pairs, leading to wider spreads and increased costs. Volatility in futures markets is often more structured and tied to specific events, such as economic data releases, geopolitical developments, or seasonal cycles in commodities. This predictability allows traders to anticipate market movements and plan strategies around these events. Forex markets, while also volatile, can exhibit abrupt and unpredictable price swings due to decentralized trading and the influence of various market participants operating under diverse conditions. This unpredictability can increase the risk for traders who lack experience or access to sophisticated risk management tools. Additionally, futures contracts provide clear visibility into trading volumes, which is a critical component of market analysis. This transparency helps traders gauge market sentiment and potential price movements. In Forex, volume data is fragmented and less reliable due to its decentralized nature, making technical analysis less effective in some cases. 6. Tax benefits in futures trading. One of the standout advantages of futures trading compared to Forex is the potential for favorable tax treatment in certain jurisdictions, particularly in the United States. Profits from futures contracts are taxed under a unique provision known as the 60/40 tax rule, which is part of Section 1256 of the Internal Revenue Code. This rule allows traders to classify 60% of their gains as long-term capital gains and 40% as short-term capital gains, regardless of the holding period. Long-term capital gains typically have lower tax rates than ordinary income, which can result in significant savings for active traders who generate consistent profits. In contrast, Forex trading is generally taxed under the rules for ordinary income unless the trader makes an explicit election to be taxed under Section 988. Under this default classification, profits from Forex trading are taxed at the trader's regular income tax rate, which can be significantly higher, particularly for high-income individuals. Although Section 988 can allow Forex traders to offset losses against ordinary income, it lacks the tax rate advantages provided by the 60/40 split available to futures traders. Additionally, futures traders benefit from simplified reporting and accounting compared to Forex traders. Futures trades are settled daily through the mark-to-market process, and brokers provide a consolidated Form 1099-B at the end of the year, detailing all gains and losses. Forex traders often have to keep meticulous records of each transaction, including exchange rates, trade dates, and rollover fees, making tax preparation more complex and time-consuming. Another tax advantage of futures trading is the ability to carry forward capital losses to offset future gains. This provision is particularly useful for traders in volatile markets, as it allows them to use prior year losses to reduce their tax burden on subsequent gains. Futures trading appeals to those seeking regulated markets, standardization, and diversified opportunities, while Forex may suit traders prioritizing high leverage and round-the-clock access. Understanding these differences helps traders choose the market aligning best with their objectives and risk tolerance.